Hey everyone, welcome. So today we are going to tackle a classic accounting puzzle, one that's covered by IAS 10. And the question is this: what on earth do you do when something huge happens to your business after your financial year has ended, but before you've actually published your financial reports? It's a great question. Let's dive in. So let's just jump right in with a perfect example of this problem. Imagine your financial year is over, the books are closed, then a few weeks later, you get a call. Your biggest, most important customer has just gone bankrupt. The question is, does this massive event change last year's financial story, or is it part of this year's? That is exactly what IAS 10 is designed to help us figure out. Right, so you have to remember that a company's story, it doesn't just slam shut on the last day of the year. There's this really important gap, this little window of time between the year end and when the financial statements actually get released to the public. And what happens in that window can completely change the picture of the company's financial health. So we need a really clear set of rules to handle it. And that's where the rules come in. So let's get the official definition down first. IAS 10 calls these events after the reporting period. And it's pretty simple. It covers any event, good or bad, that happens inside that specific window. So what exactly is that window? Okay, so this timeline really lays out that window perfectly for us. It all starts the day after your year end. In this example, that's June 30th. And it ends on a very, very specific date, the day the board of directors officially authorizes the statements for issue. Now listen, this is key. It's not when the shareholders get them or when they're filed. It's this authorization date, September 18th here. That's the hard cutoff. Everything that happens before that date is what we care about. All right, so if something happens in that window, what do we do? Well, luckily, IAS 10 gives us a really simple and elegant way to think about it. I like to call it the two buckets framework. Every single event that happens after the year end, no matter what it is, gets sorted into one of these two buckets. And this slide, this is basically the entire engine of IAS 10, all in one place. It's super important. On the left, you've got bucket number 1, adjusting events. Now, the deal with these is that the underlying condition for the event already existed at the year end. The event just gives you more information about it. For these, you have to go back and adjust the numbers in your financial statements. On the other hand, you've got bucket number 2, non-adjusting events. For these, the condition only arose after the year end. It's a new thing. So you don't change the numbers, but if it's important, you have to disclose it. Okay, theory is one thing, right? But let's actually make this real. Let's put this two buckets framework to the test and run a few common scenarios through it to see exactly how it works in the wild. Okay, first scenario. Picture this. Your company is in the middle of a lawsuit. The year ends. Then, a few weeks later, the court finally makes a decision, and surprise, you have to pay out $45,000. So, which bucket does it go in? Adjusting or non-adjusting? And to figure that out, we always ask that one critical question. Did the underlying condition, in this case the legal obligation from the lawsuit, did it actually exist on the very last day of the financial year? Well, the answer here is a definite yes. Think about it. The reason for the payment, the lawsuit itself, was already happening at year end. The court case was ongoing. The settlement after year end just confirmed the final amount. So this is a textbook adjusting event. Your action is to go back into last year's accounts and adjust them to include a provision for that $45,000. All right, let's try another one. This will help make the difference crystal clear. A month after your year end, a massive flood hits your warehouse and completely destroys a huge chunk of your inventory. This is definitely a big, unfortunate event. So you know the drill. We've got to ask that key question. On the last day of the financial year, was that inventory sitting there damaged by a flood? Yeah, of course not. No way. On the last day of the year, that inventory was sitting there perfectly fine. The flood was a brand new thing that happened entirely in the next financial period. So it's a non-adjusting event. You don't go back and change the inventory value. But this is a huge deal, right? So you absolutely have to tell people about it in the notes to the financial statements, explaining what happened and what the financial hit is likely to be. All right, you ready for a lightning round? Let's see if we can sort these quickly. First up, you find some sales invoices you forgot to record. Well, that's an error that was there at year end, so adjusting for sure. Next, a customer goes bankrupt because their factory burned down after the year end. The fire is a new condition, so non-adjusting. How about this? You sell inventory for less than it cost right after year end. This is often an adjusting event because it provides evidence that the inventory's value was probably already lower at year-end. And last one, you announce a plan to shut down a product line. The decision was made after the year-end, so that's non-adjusting. See, once you get the hang of that core question, it starts to click.
Okay, now, like any good accounting rule, there are always a couple of special cases, right? Little curveballs you need to watch out for. Let's look at two that come up all the time, because they have their own specific rules.
First one, dividends. And good news, this one's super straightforward. If a company's board declares a dividend after the year end, it is always, without exception, a non-adjusting event. Why? Simple. On the last day of the year, the company had zero legal obligation to pay anything. The decision just hadn't been made yet. So you disclose it, of course, but you don't create a liability for it in the financial statements.
Okay, the second special case, this one's a biggie. I mean, this is the rule that can change absolutely everything. We're talking about the concept of going concern. This is the real game changer. So imagine this. Something happens after year-end. Maybe you lose your one and only major customer. And it's so bad, so completely devastating, that management realizes the company just can't survive. Even though the event happened after the reporting period, the standard says this is a total game changer. The result is that it becomes a massive adjusting event. You're not just tweaking a number, you're fundamentally changing how the entire set of accounts is prepared. You switch from assuming the business will continue, a going concern, to a liquidation basis, which is a totally different way of valuing assets. It's critical information for anyone reading those reports. Phew, okay, so we've gone through the main ideas, we've walked through some examples, and we've even hit the big exceptions. So let's just boil this all down to the key things you absolutely need to remember from all of this.
Think of this as your quick and dirty IAS 10 cheat sheet. First, always identify the crucial period, that window between year-end and the authorization date. Then it's all about the two buckets framework. Every event has to be sorted. To do that sorting, your magic wand is the key question. Did the condition exist at the reporting date? And finally, always keep an eye out for those big exceptions. The simple rule for dividends and the all-powerful override for going concern. And to wrap this up, I want to leave you with one final question to chew on. While these rules seem pretty black and white, the real world is, well, it's often gray. Think back to our customer who went bankrupt. What if that customer was already months behind on their payments before the year even ended? Does that mean the condition, their inability to pay, actually did exist at year-end, even if the official bankruptcy came later? And that right there is where accounting stops being just about numbers and becomes an art. It's all about that professional judgment.